If you buy the wrong type of life insurance, you will pay 15 times more than you should, or worse, your policy could collapse after 20 years. The industry is a labyrinth of terms, holes, and universals, and buying the wrong one is like ordering a Lamborghini when all you needed was a reliable sedan, leaving you with massive payments and useless complexity. We're cutting through the jargon to give you the two-question diagnosis that instantly tells you if you need a cheap, temporary tool or an expensive, permanent fortress. Stop letting agents sell you what they want and start buying exactly what your family needs. To make sense of it all, we need to start with the single most important distinction in the life insurance world: term life versus permanent life. Everything else falls under one of these two umbrellas. Let's start with the simplest and most common type, term life insurance. Think of term life as renting your coverage. You are purchasing pure, straightforward financial protection for a specific period of time, or term. This is typically 10, 20, or 30 years. You pay a fixed premium every month or year. If you pass away during that term, the insurance company pays a tax-free death benefit to your family. It is a clean, powerful, and simple transaction. However, if you outlive the term, the policy simply expires. There's no payout and no value remaining. Just like when your apartment lease ends, you move out and get nothing back. This is why term life is so incredibly affordable. You are only paying for the risk of you dying during that specific window. So, who is term life for? It is the perfect tool for the vast majority of people, especially young families. It is designed to cover temporary but massive financial responsibilities. This includes your income replacement years, paying off a 30-year mortgage, and funding your children's college education. You buy term life to protect the years when your death would be a financial catastrophe for your family. Now, let's move to the other side of the spectrum, permanent life. Think of permanent life as buying a home. It is designed to last your entire lifetime. Because the death benefit is guaranteed to be paid out eventually, the premiums are significantly higher. But permanent insurance also includes a key feature that term does not: a cash value component. Part of your premium pays for the insurance, and the other part goes into a savings or investment account that grows over time, tax deferred. There are several different types of permanent insurance, and they are where most of the complexity lies. Let's break down the three main ones. First, we have whole life insurance. This is the most traditional type of permanent insurance. It is straightforward but rigid. Your premium is fixed and guaranteed never to increase. The death benefit is guaranteed. The cash value grows at a fixed, guaranteed interest rate set by the company. It is predictable and stable, but often offers lower returns than other options. It is often used by those who want lifelong coverage with zero guesswork and are comfortable with the higher cost. Second, there is universal life insurance, often called UL. This is the flexible permanent policy. Universal life uncouples the three main components: the premium, the death benefit, and the cash value. You have flexibility to adjust your premium payments within certain limits. You can also often adjust your death benefit up or down. The cash value earns interest based on a rate set by the company, which can change but usually has a minimum guarantee. The critical thing to understand with universal life is that the internal cost of insurance increases every year as you age. If your cash value isn't growing fast enough to cover these rising costs, your policy could lapse. It requires more active management than whole life. Third, we have the more investment-focused versions: variable universal life and indexed universal life. Variable universal life, or VUL, allows you to invest your cash value into sub-accounts, which are like mutual funds. This gives you the potential for much higher growth, but it also comes with direct market risk. If your investments perform poorly, your cash value can decrease, and you could even lose your policy. Indexed Universal Life, or IUL, is a hybrid. Your cash value's growth is tied to the performance of a stock market index, like the S&P 500. You have a floor, usually 0%, which means you can't lose money due to market drops, but you also have a cap, which limits your maximum return. It offers a balance between market participation and downside protection. Now, let's talk about two important specialized policies that don't quite fit the standard categories. The first is final expense insurance, also known as burial or funeral insurance. This is a small whole life policy designed for one purpose: to cover your end-of-life costs. The death benefit is typically between $5,000 and $25,000. The big advantage is that it's often guaranteed issue, meaning no medical exam is required, making it accessible for seniors or those with health issues. The trade-off is that you get a very small amount of coverage for a relatively high cost per dollar. The second is guaranteed issue life insurance. This is a type of policy, often a whole life or final expense policy, that is available to anyone who applies, regardless of health. As the name implies, approval is guaranteed. These policies are exclusively for people with serious health conditions who cannot qualify for any other type of life insurance. They almost always have a graded death benefit, meaning if you pass away from natural causes in the first 2 or 3 years, your beneficiaries only get a return of premiums paid. So, with all these options, how do you possibly choose? Here is a simple framework. If you are looking for affordable, massive coverage to protect your family during your peak earning years, your answer is almost always term life insurance. It is the most efficient tool for the job. If you have a permanent need for a death benefit, such as funding a special needs trust or covering estate taxes, then you are in the market for permanent life insurance. Your choice between whole, universal, indexed, or variable will depend on your appetite for risk, your need for flexibility, and your comfort with complexity. If you are a senior concerned about leaving behind funeral costs for your children, then a final expense policy is your targeted solution. In summary, life insurance is not one size fits all. It is a toolkit. Term life is your hammer, simple, powerful, and perfect for most jobs. Permanent policies are your specialized power tools, more complex, more expensive, but essential for specific, long-term projects. Your mission is to match the tool to the task. Don't use a sledgehammer to hang a picture frame, and don't use a finishing nail to build a house. Now that you understand the different types, you can walk in, ask for the right tool, and build a fortress of financial security for your family.